Good morning. It's Monday, the 21st of October, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The Take. In one of those interview questions and answers that have stayed with me for a long time, I asked then Reserve Bank of India Governor V Reddy who he visualized or thought of when formulating central bank policy. He responded promptly, the admi, the small guy, the average Joe, whoever you want to call or whatever you want to call it. There is an increasing and constant disconnect between what the regulators think and what mostly newer entrants in the banking or financial services space that they are there for or exist for. Going by the recent reactions to the recent and fresh clampdown on non-bank finance companies, you would think the Reserve Bank of India governor should first think of the life and fortunes of a venture capital firm parked in the Bay Area in California, trying to force create the next Apple Pay or something similar in India. And after having done something similar or failed trying to do so in China. Or the Reserve Bank of India should think of the entrepreneur who sold the same dream sitting in Bangalore or thereabouts so that the company in question can comfortably proceed with a Series B or Series C fundraising round, or better still, dump the entire flaming pile on unsuspecting retail investors, as some evidently have. So why is the Reserve Bank of India acting so? The primary reason is the sheer growth of personal loans in this country and the mounting evidence that borrowers are using the loans for lifestyle reasons or to invest in various financial and non-financial instruments, which also are not exactly doing well, and there's enough data already doing the rounds on that. The top-down view tells us what's going on. For instance, credit card dues as of July were the fastest growing sector, accounting for over 1% of total bank loans, increasing 22% year-on-year to nearly 280,000 crores, according to a report in the Times of India last month. Loans against gold jewellery grew the fastest within personal loans, rising almost 40%, the report said, adding that personal loans also captured the largest share of non-food credit at about 33%, followed by services at about 27%, among others. Now, gold loans is something, or the rise of it is something that we've been talking about in the core report as well. According to the Reserve Bank of India's sectoral data on bank credit, personal loans grew by about 14%, reaching about 55 lakh crore rupees. So not surprisingly, the Reserve Bank of India is watching closely this segment in addition to ringing periodic alarms. But the NBFCs in question would have you believe that they're being singled out. A collective and somewhat predictable whine went up some parts of the community as if Reserve Bank of India's surveillance department got up on a Monday morning, discovered that something was afoot and sent out closure notices on a Tuesday evening. Some pointed out that the crackdown would spell the death knell for the industry and there would be poor people who would be deprived of loan products they desperately needed. It's actually quite the contrary, but that's a different discussion. The Reserve Bank of India said last week that there were failures to adhere to the Fair Practices Code, improper income assessments, and neglect of borrowers' repayment capacities, particularly in the microfinance sector. I further quote the Reserve Bank of India, inspections revealed alarming practices, including evergreening of loans, questionable asset classification, and inadequate disclosures, all of which were compounded by outsourcing of core financial services. So, the other thing that's conveniently forgotten, that the Reserve Bank said exactly the same thing in June this year when the governor warned NBFCs and microfinance institutions of charging usurious or unlawfully high interest rates. Remember, many of these NBFCs are essentially fronts for mainstream banks who take on the slick app-based selling and overselling to customers in the guise of customer acquisition and, of course, growth. If loans were a matter of a simple swipe on a smartphone, obviously most people will take them as they are. It actually works like a TikTok, which is considered to have the best or the worst algorithms to keep you and your brains glued to the screen for the longest time possible. The difference here is, in addition to your brain matter, it's your savings that are getting drained out. Now, there are a few larger issues. The Reserve Bank of India, as I said, has been ringing the alarm bells on excessive small-ticket loans for more than a year now. It's been specifically warning against small loans going towards stock market investing or other risky derivatives trading, for example, and other instruments like maybe even crypto. So the governor said a few months ago, excessive leverage through retail loans, mostly for consumption purposes, needs careful monitoring from a macro-prudential point of view. It also calls for a careful assessment and calibration of underwriting standards as well as post-sanction monitoring of such loans. Many of the people who take these loans are India's youth. So this is not just a business problem, but a social challenge as well. Because if it was a business problem, it could have been easier to address and solve. There is no doubt that the last 4 years has seen unprecedented growth in the consumer loan space. One could always argue that this is an outcome of overall economic growth, and there could be some truth in that. But it's equally true that India is seeing levels of borrowing on one end and market speculation on the other that's quite disproportionate with many other economic indicators. Regulators have no choice but to be alert, or they would be hauled over the coals if it were to emerge that they were sleeping at the wheel. But there is little a regulator can do if companies who enter the space have a basic disconnect with what their purpose should be and the way they execute it. There is considerable potential for banking and banking services and financial services in India. Addressing this market in a commercially relevant way is important for economic growth and social progress, but it's equally important to understand who the consumer is. That's why former Governor V Reddy's statement is so important to understand and remember, not just as an academic input, but also while framing business strategy in this market that is India. And that brings us to the top stories and themes for the day. The stock markets could get a fresh set of positive cues. How will they respond? Oil prices soften once again. Gold hits a fresh record and it's back to safe haven investing. A Donald Trump presidency could mean that tariffs will go up as promised. What does that mean for Indian industry? And finally, making sense of a slowdown that is slowly coming upon us.
This is the Core Report with Govindraj Ethiraj.
The fresh cues that the market is now seeing. The big question facing Indian stock markets is what cues is it or will it respond to apart from sector-specific ones, for example, somewhat negative cues in sectors like automotive and relatively positive ones amongst IT stocks. Now, there is no large force of the kind that propels stocks to the levels we are seeing right now, apart from, of course, liquidity itself. The only thing perhaps that we can now look out for is Q2 results, which of course will be mixed. The counterforce right now is, of course, foreign portfolio investors who've sold heavily in October to the tune of over $8 billion so far, close to highs in absolute numbers, though low in relative terms. On Friday, the stock markets recovered with the BSE Sensex reversing a 3-day losing runs to rise 218 points at 81,224. The Nifty 52 ended at 24,854, up 104 points. Bank stocks did well on Friday, by the way. In the broader markets, the mid-cap index was up slightly, but the small-cap index was down. On Wall Street on Friday, both the S&P 500 and the Dow Jones Industrial Average surged to new record highs, sealing 6 straight weeks of gains, CNBC said. The Nasdaq Composite was led by a post-earnings jump in Netflix. The 3 major averages clinched their 6th straight positive week, also marking the longest string of weekly advances in 2024. But for both the Dow and S&P 500, the CNBC said. Netflix stock price rose 11% on Friday after the streaming giant beat Wall Street earnings and revenue estimates in the third quarter, while reporting a 35% jump in ad-tier memberships for the prior 3-month period. Procter & Gamble also reported better than expected earnings, while revenue fell short of estimates, CNBC said, adding that more than 70 S&P 500 companies have reported earnings this season, of which about 75% have beaten expectations. Interestingly, while the US is bracing for the presidential election, the markets are doing well. Analysts told CNBC that this is actually atypical for an election year. Usually it's the other way around, one analyst said. The market's hesitant and then it does well after the election. Now we're seeing the reverse of it, and maybe you get the opposite of what we had. Stocks will be strong into the election and then have some volatility fall on the election. The same analysts also attributed this outperformance to investors already pricing in a win from Republican nominee and former President Donald Trump, whose policies they believe will be more business-friendly in terms of taxes and regulations, but maybe not on tariffs, and more on that and what it could mean for India in a short while. Oil prices have fallen. So oil prices fell again, posting their largest weekly decline in more than a year, even as fresh moves emerged to end the conflict in the Middle East, even as, on the other hand, China's crude demand is slipping. Brent is now closer to about $73 a barrel. On the demand side, data from China showed that apparent oil demand fell from a year earlier, even amidst tentative signs of economic improvement in the world's largest crude importer, according to Bloomberg. More significantly, in the longer term, the International Energy Agency has forecast that rising global supply could lead to a sizable surplus next year, while OPEC earlier this week trimmed its forecasts for oil demand growth this year and next for a third consecutive month. Gold hits a fresh record. Gold prices have now crossed $2,700 an ounce for the first time as concerns over escalating conflicts in the Middle East and a tight US election race have prompted investors to flock to safety, according to Bloomberg, adding that bullion has climbed as much as 1% to $2,720 an ounce, beating an all-time high set in the previous session. By the way, gold was not alone. Silver too has jumped by 5.5% to the highest since 2012. Gold is now up about 2.4%, with heaven demand outweighing other macro headwinds that would normally weigh on the precious metal, according to Bloomberg. Auto exports are up. So domestic sales might be slowing, but exports are strong for India's automotive sectors. Automobile exports from India in the first 6 months of the current fiscal rose 14% year on year, led by gains in shipments of both passenger vehicles and two-wheelers, according to the Society of Indian Automobile Manufacturers, whose data says that key markets that slowed down, like Latin America and Africa, have now bounced back, which is also a reason for exports coming back. What if Trump, as president, raises tariffs? A significant promise or threat, depending on how you want to read it, is the likelihood of import tariffs rising sharply in the United States were Donald Trump to come back as president, something clearly the stock market seemed to be betting on. The Wall Street Journal says in a new article quoting experts that a new Trump term may assume that the global trading system of the late 20th century is not sustainable. The end game here isn't some kind of negotiation where we all get back to 1995 when the World Trade Organization came into force. Rather, it's a fundamental rebalancing, said that article. So what has Trump called for? Well, says the Wall Street Journal, he's called for an across-the-board tariff of 10%. He later suggested 10 to 20%, and on one occasion even said 50 to 200%. He has proposed a tariff of 60% on goods from China or maybe more, and reciprocity on US tariffs that match those of its partners. Remember the discussion on Harley-Davidson bikes facing 100% duties into India and therefore some sort of reciprocal tariff on goods going from India to the United States. However, if it turns out that the tariff on China is 60% and the rest of the world is 10%, the US average tariff weighted by value of imports would jump to 17% from 2.3% in 2023 and 1.5% in 2016, according to an investment bank, Evercore, quoted by the Wall Street Journal. Now, this would be the highest since the Great Depression, apparently, and that triggered a global surge in trade barriers. So what does this mean from an India lens, and how should Indian exporters see this, and where could this go, and what could a face-off look like? I put this question to Ajay Srivastava, founder of the Global Trade Research Initiative, or GTRI, a former senior official with the Director General of Foreign Trade in India.
The US is very, very reluctant to open its economies, and it's taking all the steps to close its borders. Mr. Trump has started this after 2018 when he imposed tariffs on steel and aluminum. So this is not new. What he is talking is not new. He is in the habit of talking these things. And of course, translating his talk into the decisions, into real tariffs. And China has faced a major brunt, and India faced the brunt only on steel and aluminum. So, of course, if he comes to the power, he may increase, but he will be ignoring plenty of reports from within the US that it's increasing the prices for the consumers. It's not helping into the job creation. So it's not helping them. But Trump being Trump, he can very well do it. And if you talk about impact on Indian exports to the US, we have a big trade surplus with the US, and the surplus may come down. But I think if he imposes on India, 2-3 things are there. One, this will not be legal. World trade, they happen under the WTO trade rules, and each country has committed how much max tariffs it can charge on a particular product. For example, India has committed that on the steel, it cannot charge more than 40%. So today, tariffs are 20% on steel. I can make it to 30% without violating the WTO rules. But US doesn't have this flexibility. They have committed very low level of highest tariff they can charge from the countries. For example, for steel, it's less than 4%. Now, when they're increasing it to 25% or 40%, they are in clear violation of the WTO rules. So first is, apart from what happens to the trade, we'll take them to the WTO. Number one. Number two, we say, okay, if you feel our tariffs are high, we are very happy to offer you zero tariff entry to your products. Happily, do an FTA with us. We are offering zero tariff facility to ASEAN, Japan, Korea, North Switzerland, Norway, Australia. So please do an FTA. We are happy to do that. But US wants unilateral tariff increases. They don't want to give concessions to other countries. So this is not the bilateral trade game. They want like my way or highway. So first I say they will be in violation if they increase tariffs unilaterally. They will be in violation of their WTO commitments. Number two, if they really want, they can talk to us for an FTA, but they don't want an FTA. Right now, we are negotiating Indo-Pacific economic framework. It's FTA sort of trade agreement with 15 countries led by US. India is also part of it. But tariff cuts are not part because US is not comfy with those things. Third, if he goes ahead and increases the tariffs, so we'll do what we have done earlier in 2019. When they increased the tariffs on steel and aluminum in 2019, we calculated how much it is hitting us. And the same amount, we did the Excel calculations and we increased the duties by the same amount on different products on US imports. We'll do the same. So it will be like race to the bottom for all the countries.
What did we do at that time in 2019? What did we increase import duties on?
So Trump in 2019, he increased tariffs on steel and aluminum, not only on China, but on most other countries, including India. So what we did is we didn't talk to Trump or anyone. We calculated how much of tariffs, how much of the revenue they are collecting out of India's exports of steel and aluminum. And the same revenue, we did back calculations and we ensured that the same revenue is charged on the imports from them. That's why we released a customs notification increasing tariffs only on the products from the USA. It's very rare for India to do this, but just to respond that we are not weak and we can also take retaliatory action, we did that.
And was that lifted later or?
Some part last year, both the countries, they say, okay, we'll agree to drop some tariffs and some disputes at the WTO. And we dropped tariffs on most of the items. But it was through bilateral concessions and negotiations.
While we may retaliate, and so will other countries, I'm assuming if the US were to increase tariffs, and like I said, the figures are quite varying, and I'm going by reports in various newspapers, including the Wall Street Journal, which are the quote Trump saying that he's talked about 10%, 20%, 60%, even 100 and 200% for different maybe products, but also some base level. In the short term, could that hurt India's exports, and where, if so?
So if my presumption is that if they are putting high tariffs on India, they'll be putting on, already they have put on China, they would put on most other countries. So it's US versus rest of the world game. And everybody will be at the equal disadvantage, and most so the US consumers. Because, we are uncompetitive on many products, but we have cheap labor and we can start manufacturing most things. US cannot manufacture garments, textiles, labor-intensive things because of their per capita income is so high and per hourly labor rate is so high. And whatever tariffs they're increasing, it will be hurting them most.
Right. So you feel that even if Donald Trump were to become president, you're saying that eventually it's not likely that he will impose those kind of sweeping tariffs, maybe only on China, or which of course they're already doing in some cases. So
my guess is he has that flamboyant cowboy type personality. He is in the habit of throwing big numbers. And tariffs are not always big numbers. As you said rightly, he used the example of Harley Davidson where duties were more than 100%. Then last month he said about wine where duties are 150%. These are the highest tariffs of India. So India's highest tariffs are 150%. What's the highest tariff of USA? 350%. Highest tariff of Japan, 450%. South Korea, more than 600%. But this doesn't mean the highest tariff, they don't represent a country's tariff schedule. For example, our average tariffs are just 17%. Our industrial tariffs are 13.5%. Weighted average tariffs are 9%. But those numbers are small numbers. They will not interest you. Trump has to make noise. So he will be picking and choosing. I hope the same principle he applies while imposing duties on certain items, and then we can talk better.
in the situation that he does become president, do you see that, let's say, companies who are more engaged or connected with global trade have to really be now on their feet or thinking very carefully about how things could evolve?
So my friends say that we should royally ignore Trump, and basically he is into the heat of the elections. He is speaking many things just for internal consumption. I may not take such actions.
Right, Mr. Srivastava. Thank you so much for joining me.
Thank you so much. Thanks for calling me.
Is there a slowdown in the air? Now, there are a series of data points that are now likely pointing to the economy slowing down. While we've been reporting the inventory buildup in passenger vehicles as one symptom, among others, there are now more signs, says veteran economic journalist and columnist Shankkar Aiyar in a new article in the New Indian Express. In that, he points out how on August 8th, the Reserve Bank of India presented a bullish outlook for the economy, projecting GDP growth for the year at 7.2%. The governor said that India's GDP would grow at 7.1% first quarter, 7.2% second, 7.3% in the third quarter, and 7.2% in the fourth quarter. 3 weeks later, the Ministry of Statistics informed that India's GDP growth had slowed to 6.7% in the first quarter. So elsewhere, companies like Bajaj Auto have already warned that the coming month will see slower sales. Reliance has already missed estimates in previous quarters. Aiyar also quotes a report published by analysts of brokerage Motilal Oswal Financial Services, which say that the second quarter will see the slowest earnings growth for Nifty companies in 17 quarters. So I asked Aiyar why this was happening, what were the signs, and what could be, if so, the solutions.
Well, these signs have been there from the fourth quarter of the previous financial year, and I've been sort of tracking some of the pattern of sales and spend. And so the belief was that, because of elections, the government spending, which sort of leads capex in India, would be interrupted during the elections, and then there will be a pickup post the formation of the government. Now, I've been tracking some data. So I look at commodities, I look at consumer durables, but I look at what is at the frontier, which is 100cc bike, oil, food stuff. So how it impacts, and I speak to a lot of people. So there has been a consistent sense among those I speak with is that while we recorded 8+% growth in the previous year, why doesn't it feel like it's an 8+% growth? And there's a lot of sort of debate about that. And increasingly in the last 3 months or so, it felt a less and less like an 8% growth. And then the data first came. So I think that it's still in the incipient stage. I still feel that this is kind of where we were in 2018 and 19, which before we hit the bottom in a sense. If one looks at the pre-pandemic data, one can see, in 2018-19, we were sort of waffling around this 6+% area. Now, 6+% is very good for most countries, not good enough for India.
Got it. One of the things you've also talked about is basically the driving force of government expenditure or capital expenditure. And that's declined both across states as well as the central government or federal government. So why is that happening?
Well, there is a weather element in this, which one must recognize, which is we've had unusually hot summer and an unusually wet monsoon. So August, I think, just like the hurricane season in the US, we seem to have extreme weather seasons in August and in May. So there has been a bit of that. But that aside, I think the government's ability to allocate, deliver, channel money, it's not enough for the government to sort of allocate something in the budget. There has to be follow-up steps to push capital expenditure. And that would be preparation. So by the time the government allocates and by the time state governments actually do the projects, it's like a 6 month. So ideally, what the government should be doing is having ready to bake projects, and then you allocate funds and move that. And this has been spoken about, but I don't think it's getting done. And which is what is reflected in the data which is put out by even the finance ministry in its August note has sort of expressed concerns about this.
Right. So the more fundamental question then, again, you've referred to various companies in the private sector. For example, Bajaj Auto, which gave a warning of sorts that sales would be down. And that seems to be the most definitive because it accounts for all the slowdown which would otherwise happen because of festival reasons or religious reasons and so on. I mean, this is pre-festival. Why is this happening? So why is consumption in India slowing down?
So first, I must put to rest one theory which will float in the next 1 week or 2 weeks and how sales have picked up. Now, obviously, if you haven't sold in August or if you haven't sold in September and you sell in October, you will have to average the 2 months. And then, so there will be that bump up in theorization that will happen, whether sales actually translate or not. Bajaj Auto is a very interesting company in the sense that it has it has a large export base.
I mean, as do companies like Maruti and Hyundai and so on.
Yeah. In the sense that Bajaj exports to maybe 6, 7 countries in different emerging market economies where two-wheelers are bought. It also is in India in the premium segment. It's not so much a 100cc bike guy, it's a premium segment. So this brings into question this theory that, frontier products at the lowest level are not doing well because there is premiumization, people are moving up the value chain. That comes into question. So, and that may play out after Diwali. So, what we have in India just now is that a property market which is probably peaking, a stock market which is at the peak and sort of is wobbly because of various valuation issues, and money is actually going to gold. So, you have a consumption issue at the higher level or first two quintiles of the income pyramid, which is moving that way. In the bottom quintiles, what is happening is high inflation, unemployment, and other regular Indian issues feeding the ability of Indians to buy, say, whatever. And the consumption data shows that consistently. I mean, in an economy which is growing at nominally around 10+%, the fact that corporate earnings are in the mid single digits or 5 or 7% tells you the gap between potential and performance.
Right. And as you look ahead, since people will also look for solutions of some sort, so one solution, I guess, which you've also referred to is obviously lowering of interest rates. Could there be anything else at this point of time?
So I've been a big proponent of two things. One is that the government desperately needs to create a national grid for perishables. Just like you can make milk available, milk is just as perishable as vegetables. You have a problem of food price inflation, which cannot be fixed by monetary policy. So there will be investments required from village level to top level. So this idea of the national e-market, e-farm and all that is not flying anywhere. I think it's like grounded like a large duck at some lake. So what they need to do is fix that problem. Second is that they should have state governments ready plug and play projects which can receive allocations and the funding and execution. So actually capex moves. And yes, I think there has to be a call on how Reserve Bank of India looks at monetary policy. I mean, everything aside, they have to explain why, if they are addressing food price inflation, why they haven't been able to address it for the last 2 years. You can't go on saying that it's seasonal for 2 years. The second part of the story is if you can't address food price inflation, park it in the fiscal basket and say, figure this out, what requires to be done. Meanwhile, on the basis of core inflation, they should move the interest rates. I mean, if globally interest rates are coming down and India keeps its interest rates high, you are imposing a cost on the economy. And that cost is both in investment in infrastructure. We are spending about 11 lakh crores. So just calculate if interest rates went down by 50 basis points or up by 50 basis points, what is the impact on the balance sheets of companies and the government? So the other part is that you are imposing a cost on consumption. Do we accept that we need consumption which forms 60% of the GDP? Yes. So then how do we manage that consumption? I mean, I think there is also a political issue here, which is there's far too much rah-rah raga about how India is doing vis-a-vis the other countries and all. All that is good, that is true. We are a true outlier. But the Indian exceptionalism has to stop at the borders because the India's relative merit depends on how well India does in India. It's not how well you do in comparison to others, but how well you do to your own potential. And I think they might want to hire some coaches from the Olympics teams who will teach this thesis firmly that athletes perform to their own potential. So India needs to perform to its own potential. And that is something that is a larger conversation.
Shankkar, that's a great note to end on. And that's how I think you've ended your article as well. Thank you so much for joining me.
Thank you, Govind.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.